For months, the global financial landscape has been holding its collective breath, waiting for a whisper of mercy from the marble halls of the Federal Reserve. We have collectively convinced ourselves that the era of punishing interest rates was merely a seasonal storm that would eventually pass, leaving us once again in the warm glow of cheap capital and effortless growth. However, the recent testimony of Kevin Warsh before the Senate Banking Committee has shattered that collective delusion with the cold precision of a surgeon's scalpel. He stood before the cameras on CNBC and delivered a message that resonated with the finality of a closing gavel, suggesting that the much-anticipated rate cuts of 2026 are not just delayed but might be fundamentally off the table for the foreseeable future. This psychological anchoring to the low interest rate environment of the past decade is perhaps the greatest trap facing the modern investor and the average household today. Many are still operating on a financial software designed for the previous decade, while the operating system of the global economy has been irrevocably upgraded to a high-yield, high-cost environment. The illusion of a pivot has led millions to stay in high-interest debt, hoping for a refinancing miracle that Kevin Warsh just signaled is essentially impossible. When he characterized the possibility of lowering rates this year as exceedingly difficult, he was not just talking about monetary policy, he was describing the death of the easy money paradigm that defined a generation of wealth building and consumer behavior. The question we must grapple with is no longer when the Federal Reserve will save us, but why we ever believed our personal prosperity should be tethered to the whims of a central bank committee. As we watch the markets react to the Wall Street Journal reports confirming the commitment of Warsh to a hawkish independence, the realization begins to sink in that the safety net has been retracted. We are now entering an era where financial survival depends not on the generosity of the government, but on the brutal efficiency of our own capital management. Are you still building your future on a foundation of hope for a rescue that is never coming, or are you ready to face the reality of the math that governs your life? What truly controls the contents of your wallet and the weight of your financial anxiety? It is not merely your boss or your monthly expenses, but a profound psychological haunting known among economists as the ghost of Paul Volcker. During his testimony, Kevin Warsh made it explicitly clear that he views the independence of the Federal Reserve as the ultimate safeguard against the terminal erosion of the American dollar. He is not operating in a vacuum, but is instead reacting to the deep historical trauma of the 1970s when the central bank failed to act decisively and allowed inflation to destroy the purchasing power of an entire generation. By prioritizing price stability over the immediate comfort of the stock market, Warsh is effectively signaling that the Federal Reserve would rather risk a controlled slowdown than a chaotic inflationary spiral that could devalue the nation's currency beyond repair. The systemic flaw we often ignore is that our modern economy has been built on a foundation of cheap dopamine and even cheaper credit. For nearly 2 decades, the average consumer has been conditioned by the Federal Reserve's low interest rate policies to believe that debt was a tool for lifestyle enhancement rather than a heavy burden. Now that the Warsh era has arrived with its focus on fiscal discipline, many individuals feel like victims of a cruel game they never agreed to play. However, the Wall Street Journal recently highlighted that this shift is a necessary correction to decades of artificial market stimulation that decoupled asset prices from reality. Understanding this structural change is the first step toward reclaiming your agency, because you can finally stop blaming your own lack of willpower and start recognizing that the rules of the game have been fundamentally rewritten by those who control the levers of power. When Kevin Warsh speaks about the difficulty of cutting rates in 2026, he is referencing the internal data from the Federal Reserve, which shows that the labor market remains stubbornly tight and core inflation is refusing to return to the 2% target. The institutional memory of the central bank dictates that premature easing is the greatest mistake a chairman can make, as it validates the worst impulses of the market. This hawkish stance is designed to break the back of inflationary expectations, even if it means higher mortgage rates and more expensive car loans for the foreseeable future. By analyzing the transcripts from the Federal Reserve Board of Governors, we see a clear consensus that the era of the Fed put, where the central bank would jump in to save the market at the first sign of trouble, has been officially retired in favor of a more austere monetary reality. The true root cause of your financial struggle in this environment is not a personal failure, but a failure to adapt to the reality that capital now has a significant cost. We have moved from a world of abundance and easy leverage into a world where every dollar borrowed is a heavy weight that drags down your future self, while every dollar saved is a soldier in a high-yield army. This is the Warsh Mandate in action, where the preservation of the system's integrity is prioritized over the prosperity of the individual debtor who refuses to change their habits. As we move deeper into this analysis, we must ask ourselves how these abstract economic theories translate into the cold, hard numbers of your bank account. What is the specific mathematical engine that can either grind your wealth into dust or propel you toward a level of freedom you never thought possible during a high interest rate regime? What is the core mathematical formula that will fundamentally alter your financial trajectory in this high interest landscape? To understand the mechanics of wealth today, you must first grasp the sheer gravity of compound interest when it is working against you in the form of revolving credit card debt. According to recent data from the Federal Reserve, the average annual percentage rate on credit cards has surged past 28% in this current Warsh environment, creating a mathematical black hole that swallows wealth faster than most people can earn it. If you carry a balance of $10,000 at these rates, you are effectively paying nearly $3,000 a year just for the privilege of owing money, which is a tax on your future self that no amount of budgeting can easily overcome without a radical change in strategy. On the flip side of this equation, we find the most potent wealth-building tool for the disciplined saver, which is the high-yield savings account and the certificate of deposit. For the first time in nearly 2 decades, institutional giants like Vanguard and Fidelity are reporting that low-risk fixed-income assets are yielding upwards of 5 or 6% annually. This means that for every $100,000 you manage to keep away from the clutches of debt, the market is essentially handing you $500 every single month just for having the discipline to wait. When you visualize this as a literal money printing machine that operates while you sleep, you begin to see that the high interest rate environment is not a crisis for everyone, but rather a massive wealth transfer from the impatient to the patient. The true magic occurs when you combine the elimination of high interest liabilities with the aggressive accumulation of these high yielding assets to create a widening spread in your net worth. This mathematical spread is the secret engine of the wealthy because it allows them to capture the high cost of capital that others are struggling to pay. In the Warsh era, the difference between someone paying 25% interest and someone earning 5% interest is a staggering 30% swing in annual financial performance, which is a gap that no career promotion or side hustle can easily close. By focusing on this delta, you move from a defensive posture of survival to an offensive strategy where your capital is working with the same intensity as a full-time employee. To illustrate this further, we can look at the historical performance of the S&P 500 during periods of elevated interest rates, which shows that while volatility is higher, the quality of companies that survive and thrive is significantly improved. These companies often have massive cash reserves that allow them to earn billions in interest income, while their smaller competitors are crushed by the cost of their own debt. This same principle applies to your personal finances, where having a cash buffer allows you to be the predator rather than the prey during market downturns. If you can master these mechanics, you will find that the very forces that are currently causing you stress are the exact same forces that can propel you into a new bracket of financial security. As we look at these numbers, it becomes clear that the game is no longer about how much you can borrow to buy things you do not need, but rather how much you can keep to fuel your own growth. The mathematical reality of 2026 dictates that liquidity is the ultimate form of leverage, and those who possess it will be the ones who dictate the terms of the future. But understanding the math is only half the battle, because even the most logical person can be derailed by their own deep-seated beliefs about money and status. We must now turn our attention to the internal landscape of the mind to discover the profound shift in perspective required to turn these cold numbers into a lived reality of freedom and power. The real difference in the mindset of wealth during the Warsh era is the transition from external validation to internal mathematical sovereignty. For years, the American middle class has been sold a version of the dream that was essentially a leveraged bet on a low-interest future. When Kevin Warsh stood before the Senate and signaled a long-term hawkish stance, he effectively announced that the price of status has increased significantly. In this environment, a luxury car or a sprawling suburban home financed at 7 or 8% is no longer a symbol of success, but a visible anchor dragging down your net worth. The truly wealthy mindset today recognizes that true riches are not found in what you display to your neighbors, but in the delta between your income and your lifestyle costs. This shift requires a profound level of psychological maturity because it demands that you prioritize the invisible growth of your brokerage account over the visible prestige of consumer goods. We must also address the paralyzing fear of scarcity that often grips individuals when they realize the safety net of cheap credit has been removed. Many people feel a sense of failure because they cannot afford the same level of lifestyle their parents achieved or that they themselves enjoyed just a few years ago. However, a strategic mindset views this not as a loss of opportunity, but as a necessary change in the theater of financial operation. Instead of participating in a housing market that is currently rigged against the buyer with high valuations and high borrowing costs, the strategist looks for alternative avenues of growth. This might mean renting a modest apartment while funneling every excess dollar into the S&P 500 or treasury bills, which are currently offering generational entry points. What looks like a step backward to the uninitiated is actually a calculated sprint toward future independence that bypasses the traps set for the impulsive consumer. A central component of this mindset shift is the radical reimagining of opportunity cost in every daily transaction. In the old regime of 0% interest, the cost of spending $1,000 was simply the $1,000 itself. In the Warsh era of 2026, spending that same $1,000 carries the heavy cost of the compounding 5 or 6% return you could have earned risk-free in a money market fund or a high-yield savings account. This means every impulsive purchase is not just a momentary lapse in judgment, but a direct theft from your future self that compounds over time. The sophisticated investor understands that money is essentially a form of stored time and energy that can be deployed to buy back their freedom. When you begin to see every dollar as a potential hour of your life that you no longer have to sell to an employer, your relationship with spending changes from emotional gratification to strategic deployment. Finally, we must recognize that the most significant difference between the struggling and the wealthy is the ability to maintain long-term conviction in the face of intense social pressure. The current economic climate encourages a frantic search for the next quick fix or the next interest rate cut that will save the day for debtors. Yet, the disciplined individual understands that the Federal Reserve is an institutional giant that moves in cycles of decades rather than days or weeks. By aligning your personal psychology with the institutional patience of the Fed, you stop reacting to the daily headlines and start building a fortress that is indifferent to the news cycle. This mental resilience allows you to remain calm while others are panicking, enabling you to make rational decisions when the market presents rare opportunities for those with ready cash. This is the ultimate shift, moving from being a passive passenger in the economy to being the captain of your own financial destiny, regardless of who sits in the chair at the Federal Reserve. Immediately after closing this video, your first and most non-negotiable objective is the total annihilation of any variable rate debt that is currently bleeding your potential. Since Kevin Warsh has effectively promised that interest rates will remain elevated throughout 2026, you must treat your credit card balance as a financial emergency that is actively sabotaging your ability to participate in the wealth transfer we discussed earlier. You should contact your lenders today to negotiate a lower rate if possible, but regardless of their response, you must redirect every spare dollar toward these high-interest liabilities because no investment in the world can consistently beat a guaranteed 28% return, which is essentially what you gain by paying off that debt. Once the bleeding has stopped, your second move is to lock in the historically high yields currently offered by certificates of deposit and high-quality bonds before the market eventually begins to price in future changes. We are currently in a rare window of opportunity where the risk-free rate of return is high enough to outpace inflation and provide a significant cushion for your lifestyle costs. By moving your emergency fund from a standard checking account into a high-yield savings account or a ladder of short-term CDs, you are effectively hiring your money to work a second job for you without any additional effort on your part. This tactical move ensures that you are capturing the high cost of capital that the Federal Reserve is maintaining, rather than being the person who has to pay for it through increased borrowing costs. The third step in your 2026 survival kit is the radical automation of your investment strategy to remove the psychological friction of decision-making during times of market volatility. You should set up a recurring transfer to a diversified portfolio of value-oriented stocks or index funds that prioritize companies with strong balance sheets and consistent cash flows. In a high-interest regime, the market rewards stability and profitability over speculative growth, so you must ensure that your capital is flowing into assets that can withstand the pressure of the Warsh era. By automating this process, you bypass the emotional urge to time the market and instead benefit from the power of consistency, which is the only reliable way to build a fortune when the headlines are filled with uncertainty and fear. These three steps represent a fundamental shift from being a reactive participant in the economy to a proactive architect of your own financial security. You do not need to wait for a change in Fed policy to start improving your situation because the tools for your liberation are already available in your banking app and your brokerage account. The true test of your financial character is whether you can translate the insights from this analysis into concrete actions before the sun sets today. As you implement these changes, you must remain vigilant against the final and most dangerous trap that awaits even the most disciplined investors as they begin to see the first signs of success in their new strategy. The most insidious danger you will face in the coming years is not a sudden stock market crash or another aggressive interest rate hike from the Federal Reserve, but rather the slow and silent poison of lifestyle inflation. As you successfully implement the strategies of paying down debt and capturing high-yield returns, you will inevitably see your disposable income begin to grow, which creates a powerful psychological urge to reward your discipline with new luxuries. This is the ultimate trap where the very success you have achieved becomes the catalyst for your return to financial mediocrity because you begin to justify higher expenses under the guise of having earned them. If you allow your spending to rise in lockstep with your savings, you will find yourself in a more expensive version of the same hamster wheel we discussed at the very beginning of this journey. We must return to the image of the mirage we explored in the opening chapter, where millions were waiting for a rescue that would never come from the halls of the central bank. The true transformation occurs when you realize that you no longer need that rescue because you have built your own fortress of liquidity and cash flow that is immune to the fluctuations of federal policy. Kevin Warsh and the Board of Governors may control the cost of borrowing, but they have no power over a person who owes nothing and possesses the capital to buy when everyone else is selling. By maintaining the same modest lifestyle you had before your financial breakthrough, you ensure that every additional dollar of interest, income, or investment gain becomes a permanent brick in your wall of freedom. The final verdict on the Warsh era is that it is a period of brutal honesty that exposes the fragility of those who rely on leverage and rewards the resilience of those who prioritize stability. You must remain vigilant against the social pressure to conform to an outdated version of the American dream that was built on the quicksand of 0% interest rates and endless stimulus. Your path to wealth in 2026 is defined by your ability to say no to the immediate gratification of the crowd so that you can eventually say yes to a life of total autonomy. Remember that the greatest luxury you can ever possess is the ability to ignore the headlines and sleep soundly at night knowing that your financial engine is designed to thrive regardless of which way the economic winds are blowing. In this new reality, the person who masters their own psychology is far more likely to succeed than the person who merely understands the math of the markets. Your wealth is ultimately a reflection of your character and your capacity to endure the discomfort of the present to secure the magnificence of the future. As we move forward into this era of high rates and hard choices, let your actions be guided by the cold logic of compounding and the unwavering discipline of a strategist who knows that the best time to build a legacy is when others are too afraid to even start. The door to the cheap money era has closed, but for the observant and the brave, a much more rewarding door of true financial sovereignty has just swung wide open. Even as the shadows of economic uncertainty grow longer across the global landscape, you now possess the lantern of knowledge and the map of strategic action to navigate the darkness with confidence. The mirage has faded, and in its place stands the solid ground of reality where your fortune is no longer a matter of luck but a matter of design.